This morning's December non-farm payroll report showed a loss of 140,000 jobs, with the unemployment rate steady at 6.7%. Significantly weaker than expectations, this represents the weakest monthly gain since April, and more importantly, the sixth consecutive month of waning momentum in terms of the pace of hiring, with weakness widespread across sectors, really emphasizing the continued negative impact that the second-round resurgence of COVID-19, as well as the subsequent policy measures aimed at stemming the spread of the virus, is having on workers and businesses, particularly small businesses, struggling to keep their doors open and stay afloat amid reduced capacity or lingering restrictions, desperate to return to some semblance of normal. Investors, however, seem to be little concerned at this point with weakness in the labor market, or more broadly, indications of waning momentum in the U.S. economy, even as the consumer continues to pull back, drawing down retail spending to a multi-month low heading into the end of the year, the key holiday spending season. Rather, the market, flirting with fresh highs, seems acutely focused on politics, not economics, elated by the prospect of further government aid, with incoming President Joe Biden suggesting the latest coronavirus aid package, totaling near $1 trillion, was just a down payment for dealing with the pandemic, and instead rebuffing concerns over potential changes in taxes or regulatory policy, or of course the longer-term consequences of a massive expansion of the federal government's balance sheet. Of course, while some argue further fiscal support on top of the trillions already allocated is greatly warranted to help millions of workers and businesses still reeling from the pandemic and local policy measures, massive government spending will undoubtedly lead to rising debts and deficits if unchecked, fueling fears of inflation and rising rates to come in the longer run. Keep in mind, outstanding debt relative to the size of the U.S. economy is already at an alarming 98%, the highest since World War II, and is projected to rise near 110% in the next 2 years. Bottom line, the U.S. economy appears to be losing significant steam after a rebound in the third quarter, as the second-round resurgence of the virus continues to squeeze businesses and workers, eliminating jobs and income, revenue, and opportunities. Looking out to the end of the year and into 2021, many businesses remain optimistic about the prospect of weathering the pandemic, particularly with a fifth-round aid package coming down the pipeline, as well as an initial rollout of the vaccine. However, with a return to normal market activity still a distant prospect, there are a rising number of businesses closing their doors for good, with millions more continuing to face challenges to reinvigorate demand or reconnect with employees or supply chains within this new environment of safety protocols and social distancing.